Module Overview. This module aims to equip you with the knowledge and skills required to access, manage, and optimize financial resources through credit facilities, loans, grants, and financial partnerships. It explores the landscape of agricultural finance, identifies financing institutions, and teaches how to prepare financially credible business documentation that appeals to funders. The importance of access to finance in agribusiness. Access to finance is often considered the lifeblood of a successful agribusiness. Whether a farmer needs to buy seeds, fertilizers, machinery, build storage facilities, or expand into processing, capital is essential. Without adequate funding, even the best ideas or farming practices may never be actualized. Agribusinesses require capital at every stage of the value chain. 1. Pre-production, land preparation, input purchases. 2. Production, labor, irrigation, mechanization. 3. Post-harvest handling, storage, transport. 4. Marketing and distribution, branding, packaging, logistics. 5. Processing and value addition. 6. Expansion and scaling. Unfortunately, in many regions, especially rural and developing areas, agribusiness operators face systemic challenges in securing financing due to perceived high risks, low financial literacy, and lack of collateral. Second, types of agricultural finance. 1. Short-term finance used for seasonal operations, buying seeds, paying workers, or purchasing feed, usually repaid within 6 months to 1 year. Second, medium-term finance, used for acquiring equipment or infrastructure like greenhouses or small-scale processing units. Repayment spans 1 to 5 years. 3. Long-term finance, used for land acquisition, building warehouses, or establishing large-scale operations. Repayment periods often exceed 5 years. Third, sources of finance and credit for agribusiness. 1. Personal savings. A. Easiest and fastest to access. B. No interest or paperwork. C. However, it is often insufficient for long-term growth. 2. Family and friends may offer interest-free or low-interest loans. B. Usually based on trust. C. Informal, but can strain relationships if unpaid. 3. Microfinance institutions, MFIs. A. Ideal for smallholder farmers and rural entrepreneurs. B. Easier to access than commercial banks. C. Higher interest rates but flexible terms. 4. Commercial banks. A. Offer structured loans and investment credit. B. Require collateral, good credit score, and documentation. C. Examples: Bank of Agriculture, Access Bank Agribusiness Desk, Sterling Bank Agric Desk, Nigeria. 5. Government schemes and development banks. A. Central Bank of Nigeria, CBN, Anchor Borrowers Program. B. BOA loans. C. Nursal Credit Guarantee Scheme. D. Youth and Women Empowerment Programs. E. Typically low interest and longer tenures. 6. Cooperative societies and rotating savings groups. Asusu, Ajo, Adashi. A. Useful for group borrowing. B. Low barrier entry. C. Encourages savings culture and social accountability. 7. Grants and donor funding. A. Offered by NGOs, development partners, e.g., USAID, DFID, GIZ. B. Does not require repayment. C. Competitive and require strong proposals. 8. Agritech platforms and crowdfunding. A. Agric-focused platforms such as FarmCrowdy, Thrive Agric, etc. B. Pools funds from investors and channels it to farmers. C. Digital, fast, and requires farm visibility and credibility. 4th, key documents required to access finance. First, business plan. A. Describes your agribusiness model, market, operations, projections. 2. Cash flow statement. A. Indicates inflow and outflow of money over time. 3. Profit and loss statement. P and LA. Shows projected or historical revenue versus expenses. 4. Balance sheet. A. Presents assets, liabilities, and equity status. 5. Loan proposal application. Letter A. Explains purpose of loan, repayment strategy, business outlook. 6. Collateral documentation. A. Land documents, guarantors, inventory, machinery. 7. Identification and legal registration. A. NEN, CAC certificate, SCUML for processors or exporters. V. Criteria for getting loans. To increase the chances of accessing credit, agribusiness owners must 1. Maintain accurate records. 2. Build a good credit history. 3. Belong to recognized cooperatives or association. 4. Prepare viable, realistic business plans. 5. Demonstrate capacity and experience. 6. Offer acceptable collateral or guarantors. 7. Show repayment ability based on revenue projections. 6th. Financial literacy and responsible borrowing. 1. Understand interest rates, fixed versus variable. 2. Know the full cost of borrowing, processing fees, insurance, penalties. 3. Avoid borrowing beyond capacity. 4. Never borrow for non-income generating activities. 5. Use borrowed funds strictly for approved purposes. 7. Common pitfalls in agricultural credit access. 1. Inadequate documentation. 2. Lack of collateral. 3. Low business transparency. 4. Overborrowing or misapplication of funds. 5. Poor understanding of loan terms. 6. Failure to meet repayment obligations. 8. Case study. Example. Baba Musa, a maize farmer in Kogi State, applied for a 1 million naira loan from BOA to expand his farm. He was initially rejected due to lack of a business plan and cash flow statement. After attending an agribusiness training, he developed a robust plan, joined a farmers' cooperative, and reapplied. This time, he secured the loan and increased his yield by 50%. Kei takiavais, viens financial access is critical to agribusiness success. Otrais multiple sources of funding exist with its benefits and risks thresholds. Proper documentation, financial literacy, and business credibility are essential. Ceturtais de type of finance most match the nature and timing of agribusiness operations.